Welcome to Brain Sense. Today, we're going to talk about a topic that can cause a financial panic and chaos: bank runs. If you've ever wondered what a bank run is, what causes it, and the consequences it can have on the economy, then you're in the right place. Let's dive in and explore this fascinating topic. A bank run happens when a large number of customers withdraw their deposits from a bank at the same time, out of fear that the bank might collapse and they might lose their money. This sudden rush to withdraw can cause a chain reaction, as other customers also start to withdraw their money, leading to a liquidity crisis for the bank. Several factors can cause a bank run. One of the primary causes is a loss of confidence in the bank's ability to repay its depositors. This can happen if the bank has made a risky investment or has a high level of bad loans. News of a bank's financial instability can spread quickly through social media, news outlets, and word of mouth, causing more customers to panic and withdraw their money. Another factor that can trigger a bank run is rumors of a bank's insolvency. Rumors can spread rapidly and lead to a sudden surge in withdrawals, even if the bank's financially sound. The failure of other banks can also trigger a bank run. If one bank fails, it can trigger a chain reaction, with customers of other banks becoming fearful and withdrawing their money to prevent a similar situation. Bank runs have been a common occurrence throughout history. In 1927, during a heated debate in the Japanese parliament, the finance minister had falsely declared that the Tokyo Watanabe Bank had failed. The bank was facing problems but had not yet failed. The minister's statement triggered a run on the bank and several others in Tokyo and Osaka. Another wave of runs on more than 24 banks occurred shortly after, when the government planned to redeem loans issued to the banks. The rumors that the bank would go bankrupt pushed people to line up and withdraw their money from the banks. In 1984, Continental Illinois, the 8th largest bank in the US, suffered a bank run and was seized by the government. It was the largest bank failure in the US till that of Washington Mutual during the 2008 financial crisis. A few years ago, the credit quality of Continental's loans to oil and gas companies had started deteriorating. Continental had acquired some of these loans from another bank that failed in 1982, Penn Square Bank. Its credit and debt rating plummeted, and it became insolvent. Later, a bank executive pleaded guilty for receiving bribes for approving risky loans. Washington Mutual was the biggest failure of an American bank. It collapsed during the 2008 financial crisis, and its assets were sold to JP Morgan Chase for $1.9 billion. Washington Mutual had about $307 billion of assets and $188 billion of deposits. In comparison, Continental's failure was worth $40 billion. Like many other financial institutions, Washington Mutual too suffered due to the subprime crisis. Saddled with mortgage losses, it announced 3,000 layoffs and the closure of 176 offices in April 2008. Within months, its stock went down to $2 from $45 in 2007. During the run, customers withdrew deposits worth $16.7 billion in just 10 days. Wachovia, a rival to Washington Mutual, would soon follow suit. Its shares had dropped 73% in 1 year. The sale of Washington Mutual had driven Wachovia customers to withdraw funds. On the 26th of September in 2008, Wachovia lost $5 billion in deposits. In what is termed a silent run, customers withdrew funds below the $100,000 limit for the FDIC deposit insurance. By the time the government stepped in, it was too late. Eventually, Wachovia was sold to Wells Fargo. A bank run can have severe consequences for the economy. It can lead to a liquidity crisis, where the bank may not have enough cash on hand to meet the demand for withdrawals. This can cause the bank to fail, leading to job losses and a negative impact on the local economy. A bank run can also lead to a systemic crisis, where the failure of one bank can trigger the failure of other banks. This can cause a ripple effect throughout the entire financial system, leading to a recession or even a depression. Governments and central banks have put several measures in place to prevent a bank run. The first measure is deposit insurance. Deposit insurance guarantees that if a bank fails, the depositors will be compensated up to a certain amount. This gives customers confidence that their deposits are safe. even if the bank fails. Another measure is the lender of last resort. A lender of last resort is a central bank that provides funds to banks that are facing a liquidity crisis. This ensures that banks have enough cash on hand to meet the demand for withdrawals. Finally, regulations and oversight of banks are critical to preventing bank runs. Governments and central banks impose regulations on banks to ensure that they have sufficient reserves to meet the demand for withdrawals and that they are not taking excessive risks. That's it for today's video on bank runs. We hope you found this information informative and useful. If you enjoyed this video, please hit the like button and share with your friends and family. Don't forget to subscribe to our channel for more informative content like this. And if there's a topic you would like us to cover in our next video, please leave a comment down below. We'd love to hear from you. Thanks for watching, and we'll see you in the next one.